Hey, what's up everybody? Scott Tennell here. Today we're going to give you some tips on how to improve your credit score to access low down payment home loan programs. So stay tuned. Hi, I'm Scott Tennell.
And I'm Tom Eichas. We are local real estate agents here in the Palm Beach County area. We help people from all over the world buy homes here, and we absolutely love it. We also post videos on real estate tips and what it's like to live, work, and play in Palm Beach County. If you're new to our channel, click the subscribe button and click the little bell to be notified every time we post a new video.
The biggest challenge for most homebuyers, especially those buying their first home, is saving up for the down payment. There are low down payment home loans available. However, low down payment home loans put more emphasis on higher credit scores. Here are a few tips to help you give your score a boost.
Tip number 1, review your credit report. I know it sounds very elementary. However, back in 2012, the Federal Trade Commission conducted a study on its consumer complaints. The FTC found 1 in 5 credit reports contained at least one error. Some errors are benign and do not impact your score, but errors in payment history, account life, and the balance you can have devastating impact on your credit score. Make sure you check all 3 credit bureaus, Equifax, TransUnion, and Experian. And if you do not subscribe to a credit monitoring service, you can still get a free copy of your credit report from each of the 3 credit bureaus once per year by going to annualcreditreport.com. Once you get those reports, review them carefully. If you find something wrong, contact the bureau reporting the incorrect information and have them investigated. Advise the credit bureau which account is wrong and go through the process of disputing the account. It's important to note, legally, you can only challenge inaccurate or outdated information on your credit report.
Tip number 2, review your credit card balances against the credit limits. Ideally, you want your credit card balances to be 30% or less of the credit limit. So if you have a credit card with a $10,000 credit limit, you want to keep your balance under $3,000 for the biggest boost to your credit score. Conversely, if you have a $9,000 balance on a credit card with a $10,000 limit, your score is getting penalized even if it is paid on time. If you can pay down your balances and you still have enough for down payment, this may give you a significant boost on your credit score, provided everything else stays the same. Even if you can only pay your credit card balances down to 50% of the limit, you will get some benefit to your credit score. Before you go out and do this and pay out all this money, review your plan with a licensed mortgage loan originator to determine if this strategy is going to have a meaningful impact on your home loan financing.
Tip number 3, address collection accounts. This one is a little tricky as you have to review how old the collection accounts are. The newer the collection account, the more of an impact it can have on your credit score. If you had a medical bill that went to collection 8 months ago and you paid off that collection account, you would see an improvement in your credit score. Conversely, if you had a collection account on your credit report that's 4 years old, paying off that account will either have little positive impact or could actually hurt your credit score. This is because the credit scoring models puts a lot of weight in the most recent 24 months of history. Like tip number 2, speak to a licensed mortgage loan originator before you address collection accounts to determine the likely impact of paying off those accounts.
Tip number 4, active credit. Practically speaking, it's great not having to service any debt. However, this hurts you when you're looking to borrow money. Creditors want to see you use credit and use it responsibly. Now, I'm not suggesting you go out and go into debt because that can be just as disastrous. However, use credit. Instead of paying cash or debit card for living expenses like groceries, cell phones, and gas, charge them. When the bill comes in, pay off the balance in full every month. By utilizing this strategy, you are using credit, but you're not going into debt because you're paying off the balance every month. You are now showing the lender you handle credit responsibly. You want to have at least 3 major active trade lines. The trade lines can be car loans, student loans, mortgages, and credit cards used in any combination. Ideally, you want every trade line to be at least 2 years old and still active. The longer the trade line has been active, the better. If you're just starting out and getting credit, or if you need to start rebuilding your credit, contact your bank or any major creditor, inquire about obtaining a secured credit card. If you would like some additional help on this strategy, contact us and we'll be happy to help.
All credit scoring models are not equal. Your credit card company, your bank, or your credit monitoring service may provide you with your credit score every month. However, a 760 credit score is not necessarily the same as a 760 credit score when obtaining a home loan. There are a number of credit scoring models out there, like FICO score and Vantage score. Generally speaking, all credit models review payment history, how you use your credit cards, how often you get new credit, and what types of credit you're obtaining. But each credit scoring model has its own proprietary algorithm on how the score is determined. In addition, some credit scoring models put more weight on the type of credit you're seeking. For example, if you're buying a new car, the lender for the car dealer may be using a version of the credit score that puts more weight on how you've handled previous car payments. In addition, other factors. Home lenders typically use older versions of the credit scores. Home lenders have more faith in the proven track record of the older models. Plus, it is cost prohibitive to retool and consistently update industry lending policy based on the newer models. With that being said, you can still monitor your credit score, and if the actions you are taking are showing your credit score trending up, the same is probably true for the model the mortgage companies are using.
If you have questions on credit, post them in the comments below or shoot us an email if you want to keep them private. Also, check out our video in Moving to Palm Beach County that will pop up here in a moment. Until next time, have a great day.
Take care.